everybody for joining us today. My name is Brian Leitner. I'm the head of wealth management for Mariner Wealth Advisors. I'm excited to be here today. I appreciate your time, and I'm really excited to have Geoff Bremer and Andrew Welzel here to join me on this webinar. So maybe just for a minute, Geoff and Andrew, would you mind introducing yourselves? And maybe Geoff, if you can start.
Sure, I'm Geoff Bremer, and I'm now the Director of Tax for the El Segundo office of Mariner Wealth.
And I'm Andrew Welzel. I'm the Senior Wealth Advisor in our El Segundo office. My primary role is to have a solid understanding of our clients' financial picture and help you achieve your goals.
So thanks, guys. It's been a really interesting year, and it still is an interesting year. We've had and are still dealing with a very serious pandemic. We've also had the markets just go on a roller coaster ride. There are fires throughout the country, a heavily contested presidential election. There's a lot going on, and there's been significant tax changes along the way, whether that be this year or in the past previous years. And so I know a lot of us are really looking forward to closing out the year. It's been one heck of a year, and it'd be nice to turn the page. But another reason that we're looking forward to the end of the year is maybe this time, which is tax planning. And while tax planning may not sound all that sexy, the reality is it is, because by being proactive, we can save dollars and invest those in a very different manner potentially than handing them over to the government. And that's what this is really all about. That's what the next, say, half hour to 40 minutes is going to be about. And so ways in which you can take advantage just before the end of the year to maybe improve your situation and save you a few dollars. And so I'm going to ask some questions of Geoff and of Andrew. And if anybody has questions, they can feel free to use the chat function through the webcam. Just to set the stage for just a second, we have President-elect Joe Biden walking into office, and while a lot of us are probably familiar with some of the changes that he plans on making, I think it's worthwhile just to discuss some of these changes. I think it'll help set the table for the conversation we're going to have. And so some of that is the change in the highest tax brackets, right? Going from 37% to about 40% at the federal level. Long-term capital gains, which are today 20% for folks that are earning over $400,000. And those are set to become potentially ordinary income. You have the payroll tax, which is going to increase for those, again, that are making over $400,000. You have the corporate tax rate that's going to increase from 21 to 28%. The federal tax exemption, so for state tax purposes, today it's roughly $11.5 million per person. If you're married, it's about $23 million. But those numbers are set to come down in 2025 to about $5 million per person. So, for years, people might say a state tax, it doesn't apply to me and it won't apply to me because those exemptions are so high. Now, things may have changed a bit. And so those are really important to address. And so maybe just to kick things off, Geoff, I'll open it up. First question to you, talking a little bit about, the election or the outcome of the election. So what are some of the things that taxpayers should be thinking about at this point, at least at a federal level?
Well, first off, Brian, I want to take exception to your comment about tax planning not being sexy. I've been doing this for a lot of years, and so I think it's very sexy. But in answer to your question, there are limited things. It used to be a lot more fun to do year-end planning because we had a lot more opportunities. As you said, the laws have changed dramatically over the last few years with the elimination of the SALT deduction, state and local taxes, the phasing out of deductions along the way, the changes in tax rates, and so on and so forth. It has been more challenging, I will say, to do some planning. But there's still opportunities available to our clients. For example, right now, under the Trump administration, they doubled the standard deduction, which means that for a single taxpayer, you're looking at about $12,400 standard deduction for this year. Married couple, $24,800, and for head of household, $18,650. So what that did was that moved a lot of people who used to itemize into the standard deduction rule, because, as I said, you can only take $10,000 for state and local taxes. Your mortgage interest deduction may be limited based on how much your mortgage is. So we've got to look at more creative ways to manage those deductions. So for example, one of the things that we recommend to our clients is the bunching of deductions. And what that means is that, let's say that you give $30,000 a year in charity. Maybe what you do, instead of giving $30,000 each year, is you double up one year, put $60,000 either to your favorite charities or put it into a donor advised fund, and then the next year don't do anything. And that way, perhaps you may move out of the standard deduction one year into the itemized deductions. And if you do that back and forth every other year, you could save some money doing that. We also look at ways of dealing with capital gains. Say someone has a large capital gain transaction this year. As you said, the market's been pretty squirrely. So people may have generated losses at the beginning of the year that they triggered, and we might want to do some tax harvesting of those losses to offset the capital gains. Tax rates, we don't know where those are going to go. As you said, Biden is proposing some tax increases. We'll get into some of the changes in the laws that may or may not occur. But if the taxes are going to increase, then perhaps you want to accelerate income into this year, or perhaps accelerate deductions into a later year. So it's just the managing of your income and managing of your deductions that are so important at this time of the year.
Thanks, Jeff. And maybe just a follow-up question. If you think about, I know both of you as advisors sit in California. So at the state level in California, is there something that we should know, any recent changes that you want to make anybody aware of?
Well, California has those crazy propositions that we see on the radio and TV ads nonstop up until election day. There were several this year dealing with taxes, predominantly in the property tax area. We had two major propositions. Proposition 15, which was an attempt to change the rules related to Prop 13 that was passed back in 1978 by taxing commercial property at fair value rather than the Prop 13 values. The other proposition was Prop 19, which did pass. Prop 19 changes the rules as far as transferability of property between parent and child as it relates to your property taxes. Up until next February of 2021, you can still transfer property from parent to child and avoid some of that stepped up property taxes. The other change was in the area of transfers of the primary residence from parent to child. You could, in the past, transfer the property tax base from parent to child on your residence without any limitation on the dollar amount. The new rule under 19 says that you can only transfer that property tax base if the parent and child use that property as their primary residence. So it had to be the parent's primary residence going out, and then the child's primary residence as they take it over.
Yeah, I mean, at every level, somebody's trying to get a piece of the tax dollar. So appreciate that, Jeff. Thank you. Andrew, to transition away from tax just for a minute, again, we just mentioned the market has had an interesting, ride this year. And at the time of this recording, we are incredibly close to, Dow 30,000, and the industry trade rags and the media. I mean, they love to talk about that. So, while we're not, folks that have a crystal ball, we do a lot of fundamental due diligence on the market and do track it closely. So without a short-term trader's mentality, what's Mariner's position right now on the markets?
Thanks, Brian. If 2020 has taught us anything, it's that humility is something we should all practice. I think anybody, to your point with the crystal ball analogy, anybody who is saying they know with a great deal of certainty, or they knew with a great deal of certainty what this year was going to hold, I'd run away from somebody like that. That said, obviously we have base cases. We're lucky at Mariner, we've got an investment team and they spend all of their time on that. And so we as advisors leverage their knowledge and their experience. As it stands right now, it's probably worthwhile to just take a step back and talk about where we thought we would be as this year has unfolded, and so what it will look like going into the future. Obviously, COVID hit out of the blue. Normally, we get some kind of warning signs if we're going to have some kind of a transition from a strong economy to a weak economy. This was essentially a recession that happened over a weekend, as most of the economy shut down. And given that, the moves were quite rapid. Our investment team at the time had thought that this would be, as awful as this is, and not to put that down at all, but as awful as this is, that we would see some rapid response to it, and certainly we did. So our view had been that we would see some rapid response in economic growth, and then some leveling off. Earlier this year we were talking about shapes of recovery, and our chief economist had talked about the Nike swoosh. Luckily enough, that looks like essentially what we're having, with a rapid increase for a good portion of the economy and then some leveling off. We thought that the markets would therefore act in a similar way. And again, lucky, good, smart, that has really panned out as well, and we've seen a nice recovery in the market. That coupled with what we've seen in terms of stimulus from both the monetary authorities and the fiscal authorities has really put us on somewhat solid footing. Our target for the S&P 500 has been 3,500. You can look at your screens right now and see that we're above that. That gives us some reason for caution. In our latest pieces, all of which, by the way, are available on our website, in our latest investment pieces, we're talking about some bias towards raising our targets for the S&P 500, but an unwillingness to do it right now because we are entering another period of uncertainty. We've seen COVID cases start to spike up again. We've got a turn in the administration, most likely at the federal level. And so all that uncertainty, we think, will continue to create some volatility. Overall, we think if we start to look forward until next year, that we will have solid economic growth, somewhere on the order of 4 to 5% GDP growth, and that therefore the markets can continue to go up. But it will not be a straight path. A little long-winded, but what we've seen over the course of the past 8 or 9 months or so, we'd expect some continuation of that going forward. Uncertainty, volatility, in general, an upward bias to the equity markets.
Andrew, thank you. And it's obviously sage advice to re-examine your portfolio right now, re-examine the amount of risk that's in your portfolio. Maybe you're in a good spot, but at the same time, maybe it's time to pare back some of the gains that you might have, or the losses themselves with the tax loss harvesting that Jeff had recommended. But just make sure you're on solid footing where you want to be, whether it be now before the end of the year, and get yourself straight so you're off to the right allocation, say start January. Jeff, we talked about this just a minute ago. You said that we don't know where tax rates are going to be, and by and large we don't. But you know this as well as I do, in fact, better than I do. We are in an incredibly low tax rate environment and have been for the last several years. And so if you think about, the spending at the government level, the deficit that we have, most tax professionals believe that taxes have to go up. Maybe we don't exactly know where they're going, but we know they're headed up from here. You agree with that?
I agree with that.
Okay.
We've got a situation where our deficit is growing at astronomical numbers. And so while we're going to have a lot of uncertainty, as Andrew spoke of, in Washington, we've got a president that's supposedly going to be Democratic. We've got a House of Representatives that will hold the Democratic line. But in the Senate, we don't know where that's going to go. We've got a runoff election that's going to take place in January. If we end up with a split split house, we're going to have a lot more uncertainty. But I think that everybody on both sides of the aisle understands that we've got to do something to start paring down this deficit we've been running up. And so I do think we'll have higher taxes at some point, whether that'll be in 2021 or 2022 or beyond, who knows? But I'm pretty certain it will happen.
So one of the things that we've been spending a lot of time on for clients are having conversations regarding Roth IRA conversions or converting your IRAs to Roth IRAs. And I know you, Jeff, and Andrew, one of the benefits of the team here is that you guys work hand in hand, right? So the left knows what the right's doing, and it's all under one roof from a tax, investments, risk management perspective, which there's a great deal of value in. And I'm going to ask you both this question, but what conversations or what are you seeing in terms of what can you share with us today regarding conversions, Roth conversions, and whether they might make sense?
Well, again, getting back to what we were just saying with higher tax rates down the road, it depends too on where that individual is. Maybe they had losses this year because of the fact that their business is doing poorly as a result of COVID. So we've got situations where clients have income that may be unusually low. And so now would be an ideal time if they have retirement funds, IRA funds, that they could move over to a Roth IRA without triggering a huge tax bite. Now might be a time to do it. You've got to look at the big picture though. As you said earlier, Brian, we've got an estate tax that may or may not go down in the near future, but will definitely go down in 2025 when the current exemption amount, the grandfathering of that expires, and we've got rates as maybe $6 million. So if you've got someone with a lot of cash that's got money in their retirement account, can afford to move that money from an IRA to a Roth, pay the tax with other sources of income or other sources of cash, that might be an ideal situation for them.
Yeah, and just to be clear, it's an ideal situation because it reduces the size of their gross estate. So if they are looking at a potential estate tax, that mitigates that, again, depending upon how much money we're talking about. But once you pay the tax today on the conversion, whether you do so all in one year or spread it out over several different years, again, if you're paying the tax today and potentially taxes are you're in a lower tax rate today than you will be in the future, all of that growth will then be tax-free, which is part of the benefit, right? And the government loves this idea of getting their hands on the money today, versus maybe many years down the road. And so, Andrew, I know that there's a lot of different modeling that you do, as well as obviously all the advisors at Mariner as it relates to this. Is there anything that you want to share from the Roth IRA conversation?
Yeah, just kind of a general comment or two, and then perhaps it'd be worthwhile to show an example. And I've teed up one that I'll share on my screen in a second. When we're looking at this, Roth conversions is something that we look at on not just an annual basis, and we are looking at it for a good proportion of our clients on an annual basis, but also as part of multi-year planning. So with all of our clients, we want to do some cash flow modeling going out several years with some skepticism because we're forecasting into the future, but try and model what it most likely will look like going out those years. And what we're really looking at when we're looking at a Roth conversion is kind of a trifecta of results. First and foremost, by keeping more after-tax dollars in your pocket, growing the value of your investment accounts. Number two, and you both have hit on this, as you grow those assets in a Roth retirement account, those become tax-free assets for non-spouse beneficiaries. And there's a huge benefit for them, for our kids or grandkids who might inherit our Roth IRAs, to inherit something on which they don't have to pay income taxes. And then the third benefit, it's kind of the other side of the coin, is a reduction in lifetime income taxes. Perhaps just a second, a primer on this, and just to make sure that everybody's on the same page when it comes to the difference between a traditional and a Roth retirement account. Just a couple words on that. So traditional retirement account, IRAs, 401ks, those accounts are funded with pre-tax dollars that haven't been taxed as income yet. The balances in those accounts grow tax-free. And then there's a requirement starting now at age 72 to take money out of those accounts. As the money comes out, again, forced, it's taxed as income to you. Quite often, those amounts are high enough to put you in high marginal tax brackets. Traditional retirement accounts. Roth retirement accounts, by contrast, funded typically with after-tax dollars that have already been taxed. The growth, the same, is tax-free. There's no requirement to take money out of the Roth retirement accounts, but to the extent that you do take money out, since it's already been taxed going in, there are no taxes going out. And so that's essentially what we're looking at. And so I'm going to switch over. Can you see my screen?
Yes.
Yes.
Excellent. And so we've modeled a sample client here. This sample client is near retirement. They're about 3 years away from retirement. They've amassed some net worth in both retirement accounts and in real estate. This, by the way, is the financial planning software that we use. Some of you may have gotten a link to this, and we always encourage our clients to set this up. It's a great way to track your overall net worth and some of the modeling that we do. In any case, so this is our situation, a client who's a few years away from retirement. And when we're looking at a situation like this, we are looking very specifically, for years in which their income tax rates are going to be low. So here's the client who's working for a few more years, and then the first year of retirement is age 60. You can see their effective tax rates over here on the right-hand side, somewhere near 30% effective tax rates that drop for many years into the single digits because of that loss of income. This is precisely the situation that we're looking for. And when we see that, it's kind of a prompt for us to look for the situation where we can do Roth conversions. What we're really trying to do is play a little bit of tax arbitrage, where we take advantage of those low tax years. Here I'm comparing not doing anything to doing some Roth conversions between age 60 and age 72. And you can see not doing anything during the years you're still working, that total income tax right around 80 to 90,000. Not doing anything, that income tax that you're paying drops to about $5,000 for several years. Your brilliant financial advisor here, tongue in cheek, is saying, hey, let's pay another $30,000 in taxes for several years. May not seem like the best idea, but it's so that when we turn 72 and our tax rates go back up, we've got that higher tax payment now, somewhere in the 60,000 range, and going higher as those required distributions go up. Versus here, keeping it pretty steady. In the 30 to 50 range, it does rise later as portfolio balances increase and investments increase. So we're smoothing out those taxes. You can see it graphically here, low tax payments for a good portion of time, and we're just smoothing it out such that those tax payments never rise much above 75,000 here, whereas you've got several years of 100,000 to 200,000 in tax payments. So smoothing out those tax payments, which results in this great outcome where we are growing, where we are keeping more after-tax dollars in our pocket, growing our assets. Again, here, comparing the growth of assets, not doing anything on the left-hand side here versus doing those Roth conversions. You can see we're doing 100,000 in Roth conversions for about 12 years on the right-hand side. If you look at these total portfolio balances, you'll see on the left-hand side, it's higher in these early years of having done the conversions because we paid taxes. As we go through time, there's a break even, and then we run this out to age 95 for most of our clients. You can see at the end of the day, we've got about 2.2 million more in total portfolio assets as a result of this tax efficient plan. In addition, this third column here that doesn't exist on the not doing Roth conversion side, just under $8 million in tax-free assets that we've accumulated, which is a huge gift to be able to, for non-spouse beneficiaries to inherit.
So Andrew, I really appreciate you walking through that examples. And I know for people watching this, maybe it's a little too much. There's a lot of numbers. It looks like a spreadsheet, and I understand that. But I mean, I think the key takeaway is that you called it smoothing out your tax brackets. Other people might call it playing with the tax bracket. So how much can I do? How much income can I accelerate before it pushes me into the low income tax bracket? Or what you were doing was looking at certain years where the income was low. Could be from losses of a business, could be from retirement before they start pulling money out. Looking at that time frame as potentially a really good time to do it. Even folks that may have lost their job, but they have the resources to pay the tax on it today. Because the benefit ultimately is that money is going to grow, again, tax-free forever. There won't be this idea of you have to take RMDs from this account, required minimum distributions, because that does not exist inside of these accounts. And so if you think about, again, the compounding of the tax-free nature of these investments, there's a massive benefit to it. And it's like anything else, and to some degree, it's you pay the piper now for something down the road. And it's an incredible wealth transfer opportunity, but it's an incredible way also to diversify the assets that you have today. Because what a lot of folks do is they have all their money in their tax deferred assets, and all of a sudden they start pulling money out. And Andrew, to your point earlier, it doesn't take that much to jump up in terms of the tax bracket when you add in minimum distributions and potentially other sources of retirement income. So it's a great way to legally manipulate your taxes in terms of the way out. A fun little statistic, people often say the accumulation part of your wealth is sort of the easiest part, whether that's right or wrong, but it's actually pulling out the money that's the most difficult, because there's a lot at stake there, and small mistakes can cost you a whole lot. It's that the joke is, I think it's when folks climb Mount Everest, 80% of the injuries actually happen on the descent. Similar in this sense too. So Andrew, I really appreciate you walking through that analysis. I know a lot of people see information that's out there, but when you can actually quantify it, I think that's when it's most helpful. So I appreciate that example.
Brian, Brian, can I jump in one other comment on that? The rules changed as well on the IRA area. And it used to be that when you inherited an IRA, if you were a non-spouse, you got to spread that out over a long period of time. And under the new rules, non-spouse distributions from an IRA have to be liquidated within 10 years. So that could throw the next generation into a massive tax bracket as well.
Yeah, it's a great point. Out of the Secure Act and some of the changes there. So just to elaborate on that for just a second, non-spouse beneficiaries, maybe the children, they used to be able to stretch these distributions out over their entire lifetime, maybe 40, 50 years. Now it has to be done in 10 years. And for every dollar they pull out, if they're adult children, maybe they're working, maybe they're already in a high income tax bracket. Now you're talking about a substantial amount of income potentially over 10 years, or worst case scenario, the way certain trusts are structured today, that are the beneficiaries of some of these trusts, it may have come out all in 1 year. So with that said, it is a great time to review your estate planning situation. And every time I say that, when I'm face to face, a lot of individuals will say, all right, Brian, I appreciate this. I'm going to go speak to my estate planning attorney. I don't think that's the first stop on the route, if you will. I think getting together with your advisor, your CPA, and making sure that all your ducks are in a row before you go to see that estate planning attorney can make all the sense in the world. But having said all that, Andrew, maybe a good segue into a conversation, a question for you is, what should people be thinking about as it relates to their overall estate planning situation right now?
Thanks, Brian. I think there are always kind of two components, kind of that annual planning and the longer term planning. The annual planning first, one of the things we're always looking at with clients is, first you want to check capacity. Do you have the capacity to start giving assets to that next generation? We want to make sure that our clients have enough assets to pay their bills, to make sure they can live that comfortable lifestyle during their lifetime. I love the saying, you know, you've got a few places where your money can go. You can spend it yourself, and if you don't fly first class, your kids might, right? You can give it to your kids, which is great. I like that saying. You want them to struggle but not suffer, so helping them along the way is a nice thing to do. You can give it to charity, or you can give it to Uncle Sam. Most of our clients want to disinherit that last guy. And I always say, you know, estate taxes are a voluntary tax. You don't have to pay a dime in estate taxes. You got those first two, yourselves and your kids or grandkids or other family members. But if you leave the rest of it to charity, you pay a dime in estate taxes. And so first we want to check that capacity, make sure that we're not doing things that are irrevocable, that might hamper our lifestyle. So when we think of annual things that we want to think of every year, first we're thinking about annual exclusion gifts. Right now, any one person can give anybody else $15,000 a year without having to file a gift tax return, no gift taxes on that. So as a couple, $30,000. We're just doing this analysis for another client, giving $30,000 to their 3 kids each year. They're in their mid-50s, so many years that they can do that. They reduce their estate tax bill by something like 75%, their projected estate tax bill. Just doing that regularly is a great way to at least get started if you have that capacity. And that compounding is huge. So that's one thing we want to think about. We've already talked about charities and bunching in years, like doing donor advised funds. That's a great practice where you can give a lot to a fund, and you can call it the Johnson Family Foundation. You can give a lot today if you've got a high income tax year and get nice deductions from it. You don't have to give everything away today. You can dribble it out over the years, but it's a great way to do both tax and estate planning. So that's another thing we want to think about, is something that we think about every year with our clients. When it comes to longer term planning, and again, some of this annual planning becomes longer term planning by its very nature, but some of that longer term planning that we're thinking about, and again, you touched on it earlier, we're looking at estate tax exemptions right now. We're looking at the fact that as a couple, we can give away $23 million during our lifetime without paying any gift taxes. At our death, we can give away that same amount. We know that that will sunset in 2025 and get cut in half. We're also reasonably sure from current case law that if you give away a lot today and tomorrow the government says, well, we're cutting it in half, that you're exempted from that you're grandfathered in. So we've been doing a lot of planning in this fourth quarter, especially with some concerns about a blue wave, and that there would be some reduction in estate tax exemptions. That has gone away a little bit, but it's always a good idea to think about, again, if you've got the capacity, think about getting assets out of your estate today, because it's not just the amount that you get out, it's all that growth. And again, that accumulates. You don't necessarily have to give that to your children who may not do the best job in the world with $5 million each today. You can put it in trusts and control it during your lifetime, and even in their lifetimes, pass that along to generations. Those type of irrevocable trusts are types of the planning that we're doing all the time with our clients.
Yeah, Andrew, that's great. And thank you very much. To your point, I think it's often overlooked how much you can reduce your estate just by the annual exclusions and having a game plan over a period of years. And then for the right opportunity, leveraging that so you're not just giving cash, but assets that can further accelerate some of those gifts and what that looks like. And so I think that's really interesting. And one thing I'll throw in, earlier this week, I had a conversation with someone, and we were talking about gifting, and something I think that comes up that sometimes we all often forget is what's referred to as the education and medical exclusion. And that's where, instead of writing a check to your grandson or a granddaughter, if you will, for college, and a lot of folks will will write the check to, Johnny or Jane, as opposed to making that payment directly to the institution. If they write it to the child, it's going to count as a gift and go against that annual exclusion. But if they write the check directly to the institution, it's free game. The same is true on the medical side. And let's face it, look, if you right now, if you take a look at what college costs, what the debts are for kids coming out of college, and you take a look at what's going on at the hospitals today, those are great things to have in your back pocket. So excellent opportunities on the annual side. So thank you, Andrew. And something else to just pay particular attention to, there's the federal side of things and the state side of things. So making sure that your documents have been updated on a regular basis is really, really important. So guys, I appreciate this conversation. We're wrapping up on time here. So I want to thank you both for joining. And of course, I want to thank everybody else for attending. We greatly appreciate it. If you enjoy content like this, please visit our website at maritalwealthadvisors.com. You'll find other webinars and upcoming webinars. You'll find our podcast and other sets of videos, as well as a bunch of different white papers, because look, you can't get enough of this stuff, So those are some different things to think about. In addition, if you haven't reached out and you'd like a set of eyes, to maybe a second set of eyes to review your current situation, please reach out to us. We have a complimentary conversation about your situation. Frankly, even if you're working with someone, maybe a second set of eyes will give you peace of mind. So please give that some thought. Take a look at our website. And again, thank you very much. And I wish everybody a happy holiday season. Thanks again for watching.